Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Kevin SigRist, Chief Investment Officer for North Carolina Investment Authority, will join us. So listeners have a high-level sense of our roadmap for today. We'll start with some background, then discuss the usual. Investors, academics, and business leaders should be able to extract a great deal of value from Kevin's insight. On that note, welcome, Kevin.
Thank you. It's a pleasure to be here.
Great to have you. Why don't you start with your background, just briefly how you got to where you are today?
Sure. So my kind of training and education is in economics and econometrics. Worked for a time as an econometrician. First started working on financial markets and financial research way back in the 1980s. I was a research assistant for a think tank at Washington University in St. Louis, where I did my graduate work. And we did stock market studies and things like that. And I worked for a bank, Norwest, which merged in with Wells Fargo, did country risk analysis and regional economics. Then moved to the pension side. So that was with the Florida State Board of Administration. They invest the Florida retirement system dollars. I was there for about 17 years. Then I came to North Carolina as the chief investment officer in 2013. Left here in 2017, middle part of that year. Then I went to work for a new subsidiary called the Wasaya Global Investment Company, set up by Saudi Aramco to invest their pension monies and other portfolios. I actually retired from there and then rejoined the department here, the North Carolina Department of State Treasurer, in January of 2025. So that's a thumbnail of my background, yeah.
Yeah, that's helpful. And what's the objective of the plan, perhaps in terms of return, and then if there's risk or other components to your fiduciary duty?
Sure. So there's really two threads I'll hit in terms of the objectives, because we're going through really a unique change in our governance and organizational setup, and that's informing how we think about our investment objectives as well. So North Carolina for many years was one of the sole fiduciary states where the state pension plan and other asset pools were under the control and direction of a single elected official, the state treasurer. State treasurer is a statewide elected official. It's been that way since, I think, the very beginning of the state. And there were some initiatives over the years, including when I was here the first time, to modernize operations and governance and adopt a more traditional board governance structure. We've gotten that across the finish line. The current state treasurer, Brad Briner, former co-CIO for Willett Advisors, he ran on a platform of modernizing the governance to adopt best practices to address longstanding disappointing investment performance. And so he was elected on that basis, along with some other reform measures he wanted to carry forward with some of the other programs here at the department. And we, in 2025, were able to get the General Assembly and the governor to agree to a quite significant change in our governance. So now we have a 5-member professional board. I can talk a little bit about some of their kind of background and qualifications, but we have really a change where the state treasurer sits as the chairman of the board and the professional management team is responsible for the day-to-day management. So we're going through a stand-up of a new organization called the North Carolina Investment Authority, we're still located in the department. We have a very tight connection with the department as the custodian of the assets and the plan sponsor for the various retirement systems that we help invest, as well as some other asset pools. And so that's the first thread of what we're accomplishing and the really key objective we have in the near term.
And then in terms of maybe quantifying it a bit, in terms of maybe metrics, like targets, risk, return, size of the plan.
Sure. So all told, we're responsible for investing about 200 billion. The lion's share of the monies, 140 billion plus, are in a consolidated defined benefit retirement pool. So we refer to that as the North Carolina Retirement Systems. It's, I think, 7 or 8 underlying retirement plans. They're all DB plans of some sort. And then we have short-term state monies we invest. That's closer to 40 to 50 billion. And then we have a defined contribution plan called the North Carolina Supplemental Retirement Plans. That's about 20 billion. And then we have some smaller mandates as well. For the retirement plan, historically, that plan has been invested very conservatively by any metric, whether you look at the beta to the equity markets, the amount in high-grade fixed income and cash. We've really, for many years, been amongst the most conservative plans in the country. That has not turned out well for performance. So for, say, the decade ended 2024, we're one of the lowest performing state pension plans, pension systems in the country. So we're going through a asset liability study now. We'll finish that in February when we go back to our board with some recommended changes to the asset allocation. And what we're pivoting towards is more of a focus on achieving a reasonable return above the actuarial assumed investment return, which is 6.5%. So you can think of our objective as being more focused on generating a good return that can compound over time and modestly exceed that 6.5% annualized return net of fees and expenses. We have less focus going forward on the standard performance benchmarks that are typically used by public pension funds. Our 2 primary benchmarks will be the actuarial rate of return as well as a reference portfolio, which is most likely to be 65% broad global equities and 35% US Treasuries with 5 years of maturity and beyond.
Yeah, just clarify, when you said you were running conservatively, I mean, I could read that different ways. I'm assuming like maybe an overweight in, not you per se, but the plan historically was run conservatively and that caused underperformance, if I didn't misunderstand. That was over allocation to fixed income and less to more risk-seeking assets. Is that the gist of it, or did I get that wrong?
No, that's the biggest dial that's going to drive the risk profile. So we had more in high-grade fixed income, about 15 percentage points more in high-grade fixed income and cash than, say, the average state pension plan. So that in and of itself, given the low interest rate environment that we've seen for years and years until 2022, kept returns fairly low. And then in addition, we had about 8 years or so of very limited activity in the private markets, private equity, real estate, private credit, hedge fund space. There was really very little appetite for about 8 years to allocate into those types of strategies. There was some, but it was very uneven in terms of the activity.
Got it. Got it. Okay. And let's see, start getting into alpha, the subject of this podcast, and innovation, the other subject of this podcast. It'd be interesting to hear, you started to touch on governance, so we've hit a bit on that at the beginning. But what about from an investment perspective? How do you innovate and to improve alpha from an investment perspective? I know it's easier said than done.
Yeah, and I think it's also important to understand, again, our context. We're trying to shift away from thinking of alpha as producing returns above and beyond the kind of standard performance benchmarks that everybody utilizes, right? So set your strategic asset allocation, If you're a mature plan, you're pretty close to your target weights, and then go pick the best managers. That's the standard template. What we're trying to achieve going forward is to say we actually can't live in that relative return space and think of alpha as just relative to manager benchmarks, peer groups, universes, and things like that. Really, what we're expected to do is keep the plan well funded and drive it towards being full funded. And that has some very salutary effects in the form of the sustainability of the plan over time. So it keeps the employer contribution costs low. It improves the likelihood of providing COLAs to retirees. All of these are like the primary objectives. And to do that, we have to earn a return fairly consistently of 6.5% or better, right? The art will be, if we define alpha as exceeding 6.5%, how much are we aiming for? The early modeling on the new portfolio would put us closer to somewhere north of 7%. So to try to create a reasonable buffer over time. And so when we think of alpha, it's more relative to that absolute return as opposed to, okay, we have a fixed weight on ACWI, we have a fixed weight on the Barclays Ag, or Bloomberg Barclays Ag, we have a fixed weight on Cambridge Private Equity Universe, boom, boom. So we're trying to shift the perspective. It's a little scary, to be frank, because now we're talking more about we need to manage market risk as opposed to just relative risk in manager selection. It's all on the table. But key to our process going forward, and we've been doing this for a time, we're just amplifying it, is within our investment committee, as we look at deals and what we're trying to achieve with our relationships, is we're very well diversified in public markets. We always will be. So we look to the private markets to bring to the table concentrated idiosyncratic risk, right? Again, that's a little scary that we're going to water down the diversification on the private market side. That also raises the risk of disappointment and zeros. Nobody likes to have those. But if we're really credibly going to add returns over and above both the 6.5% and then a reference portfolio, we have to have that idiosyncratic risk. You just can't really reasonably expect to take no risk and still create this amorphous alpha. So our focus is in the private space, be much larger with our investments, be much more concentrated with managers as well as co-investments, lean more into separately managed accounts where we can opt into co-investments or elect not to, and really drive that part of the portfolio, the non-public side, where we really want to take the major risk to try to add that additional value add or alpha.
Does obviously, we're all quite familiar with the issues private equities had in terms of distributions or lack thereof, where for the last few years, distributions have been, I think, about on average at 12%, half of the 25-year rate, which happened to be about 25%. So there's this lack of DPI, and obviously continuation vehicles have exploded. The secondary markets exploded, partially, if not largely, for the aforementioned reason. How does that fit in the equation? Or,
well, good news, bad news, right? We've had weaker than we would like performance for a long period of time. We haven't been as active in the private space. We've had excess cash, right? So now we're in 2025, 2026, and we can deploy. So from our perspective, we're less concerned about the low DPI. We're not exposed to that many continuation vehicles in existing funds, but we're seeing a lot of deal flow in the form of the ability to be anchor investors in CVs, be large in co-investments as well. So this kind of environment for us is actually very appealing. And we're able to look at co-investments and execute more in the 200, 300 and above level. That gets a lot of attention, as you would imagine, from the general partners. And for us, it's a great environment, given our circumstances. If we were a plan that was fully invested in overweight private equity, I would have a much different view. But we're not. Yeah.
Got it. Okay. And what about in terms of innovation to improve innovation in alpha from a technology perspective? How do you look at that? Is that the type of companies you invest in, or is that systems, or is that, I'll leave it open ended there. Sorry.
Sure. I think from our perspective, we're really in the early stages of deploying AI. We see that as really one of the more interesting things that can impact the way we actually operationalize our investment process, create the collaboration between the teams. And we just see that as a phenomenal potential facilitator of what we're trying to accomplish on the investment side. If we're trying to amplify the potential excess returns alpha that we get from the private space, there's so much overlap, particularly between equity markets, the public equity markets, late stage growth, venture companies are growing so rapidly at the moment. And then there's potential for collaboration between our private equity team, our public equity team, but also on the real estate and the real asset side because of the importance of energy, power, data centers, all of this. We've had a couple of co-investments come to us in the late stage venture side, and we've scrambled a working group to pull research from managers as well as other sources. And it's people from our multi-strat team, so they're connected to hedge funds. We have our real assets looking at the infra side, private equity that focus on late stage growth, and our public equity portfolio managers as well. So to us, that's one of the more exciting things because we want this competition for capital across the teams in front of the investment committee before we make our kind of final allocations. And we see that technology is really facilitating, not replacing, but really facilitating that collaboration and the ability to connect all these disparate views from different types of investors. We don't presuppose that we have any great predictability or any ability to predict, I think is a better way to put it, where all of the AI, the data center investments are going to end up, which are going to be the winning companies and such, but we definitely want to be at the table and be able to allocate into this.
No, that makes sense. Okay. And you touched on it a bit in terms of the change in strategic asset allocation. But if you were to, I don't know if you care to go any deeper in terms of where the best opportunities from an investment perspective are now.
Yeah, and it's I'll touch on a couple of areas that we particularly like. We like global macro. So we think the rise in kind of dispersion across markets, geographies, the importance of geopolitics over the last several years, we think that's going to continue. We really think global macro is a good place to be allocating into. We're setting up arrangements with managers that likewise can also generate co-investment flow in that space. We have a house view, and we're not necessarily going to agree with all of our global macro managers, and nor do they agree with each other, right? That's what makes markets. But we want to have that ability to double down and effectively have a center book to work off of these relationships with our global macro managers. So we like that space. We also like, and this is more relevant to the absolute return orientation, we really like commercial real estate mortgages. And we've done one roughly a little bit north of $1 billion allocation to a new relationship there. We have a couple more in the works of similar size. And we're pivoting away from generic high yield leveraged loans, some private credit exposures that we feel those are really pretty well priced. And we've seen some pretty significant drawdowns in the market in that space recently. But we think we can produce through these relationships 8 to 10%, maybe a little bit north of that for the intermediate term with fairly high quality commercial real estate mortgages in sectors. Maybe a little bit of the properties are transitional, but the risk profile to us is really the sweet spot when you think about us trying to generate 6.5% over the long term. So that we like that because we're not trying to create a lot of excess value. It's a beta play, but it fits very well with that absolute return orientation.
Got it. Okay. And what's the biggest challenge to achieving the plan's goals?
I think the primary challenges historically have been around governance. And I feel like we've made great progress on that already. Our board is very supportive. They're all current CIOs, former CIOs. One has very long-standing experience in venture capital in the private space. And so they get what we're trying to achieve. And they have moved quickly to help us establish the foundational aspects of the new governance model and the organization, our processes. So we're trying to hire in people that are more experienced in the direct investing space. So we've already brought several people on with investment banking backgrounds, family office backgrounds, things like that. So we do need to build more team members and more expertise there. I think markets do what markets do. And
Yeah,
we've
that's for
had
sure.
some choppiness, which we've navigated reasonably well. I think the biggest challenge is trying to get right how much of the geopolitical stuff do you ignore and just look through versus when does it become real and material, and when is it going to impact markets for more than a couple of weeks or a month. I think that's our biggest challenge in trying to navigate. I think we keep our eye on the long term. That's helpful, including when things get dislocated. And with the liquidity we have, we can step into those dislocations. But I've had experience in the past being too early, say around the GFC, and things look like a great value, say around the Bear Stearns collapse. But
And
then,
you catch a falling knife.
yeah, exactly. So to me, that's one of the biggest challenges that we're facing at the moment, that we do have liquidity so we can deploy quickly, but we also need to be patient.
Yeah, completely understand. In any case, what's a red flag with a manager such that you wouldn't invest?
I think at the manager level, it's really around alignment. Two things. Alignment is super important to us. And in the private space, there's always conflict, right, of interests that come up. So that's not a litmus test. It's really how does the manager, general partner, ensure that there's a credible mechanism to surface conflicts, address them so that the investors, the LPs, can be comfortable. And so to me, that's always a red flag. The other is, and there can be several variations on this theme, managers that don't really learn from mistakes. I'd much rather invest with a manager who has stubbed their toe, had issues, they acknowledged it, they were proactive, they fixed the root cause, and they're transparent about it, right? And move on. It's fine. But I think when you're underwriting an investment manager, a general partner, and they're just not willing to acknowledge what's obvious, they got an SEC fine, and they just want to blame the SEC as opposed to saying, yeah, we had weak controls, we were under-resourced, we weren't institutional, we accept that, we fixed it, here's why it won't happen again. I think to me, those are the two most important issues to be focused on.
Yeah, I totally understand. What's a material mistake you've made investing and a lesson learned?
Well, one is what I mentioned before, which is being overly anxious to take advantage of perceived dislocations. I think
Yeah.
that's an easy mistake. I feel going back to the GFC and before that, but also after, a lot of institutional investors took on that opportunistic mantra of it was all with the benefit of hindsight, right? That, oh, if only we had been more opportunistic when markets were massively dislocated and everybody was running for the hills. And there's so much liquidity that's been in the markets for so many years, it's tough to be opportunistic. And markets bounce back quite rapidly. So if you move too soon, right, then as you mentioned, you have the falling knife problem. If you move too late, there's already so much capital in there that you're not actually going to get any benefit. It's all been bid away already. So I think that's an important lesson learned. I think another one is around the importance of operational controls, ODD, making sure that there isn't excess focus on the fun stuff, investing, and that you have to be on top of all those enterprise risks. And the enterprise risk management is never going to create alpha, right, or excess returns, but you can't be successful long term without having a good control environment, having the right expertise and resources. And if you run things on a shoestring, eventually the shoestring breaks. and it's almost always in the operational area. So to me, that's an important lesson learned also.
And what about inflation? It's every episode we joke it's either been a material issue or not been an issue or controversial. Certainly for the Fed and our executive branch, it's controversial. Do you have a view? Does the fund have a view? Does it impact your allocation and or investing at all? I know you mentioned your 6 and change hurdle or target rate of return. So obviously that inflation has a significant impact on that. So thoughts?
Yeah. Inflation is front and center for us because we have such a strong orientation to asset liability management.
Yeah.
Our liabilities are driven by wage inflation and by the cost of living adjustments that are provided to retirees. So we go through a fair bit of advanced modeling, Monte Carlo modeling, as well as scenario analysis to look at adverse scenarios. The worst for us is stagflation because liabilities are growing rapidly because general inflation is bleeding into wage inflation over several years. And then there might be COLAs. So we need to bake that into our portfolio construction. Historically, we had a dedicated asset class called inflation sensitive. And the normal portfolio for that asset class was an allocation to tips, short maturity tips, as well as commodities. We never really liked either as just a straight investment. We maintained a little bit of exposure in each, but we used tip substitutes, a lot of asset-backed securities, investment grade, but they would benefit either from credit enhancements or directly floating rate notes from inflation. And then we did a lot of real assets, infra, miscellaneous real assets like rail cars and things like that. That portfolio, when inflation was spiking post-COVID, was printing at 9% plus. So we felt that it worked pretty well on a standalone basis. The rest of the portfolio struggled. But yeah, so we do think a lot about inflation. We're not convinced that we're going to get back to the Fed target 2% anytime soon. And we're seeing a few kind of green shoots of inflationary pressure throughout the global supply chain. So we're still not really convinced that the inflation fight is over in the US.
Got it. I don't disagree. I think it's lagging. There's tariffs will still have an adverse impact, and none of that's gone away with the daily threats and inflation expectations are reflexive and self-fulfilling. Anyway, okay. And have you read any good books lately, or any books you like or recommend or favorites?
Yeah, to be honest, I have not read a book in a while. It's tough to carve out the time for stuff like that. I think my favorite book is still from a long time ago, Running and Being by George Sheehan. And it's completely non-financial, which is nice. And it's more of a kind of a meditation on, doing things just for yourself. And George Sheehan is quite fond of the Greek philosophers. So it's a nice, pithy book. Definitely one of my favorites. Yeah.
I'll check it out. It's actually new to me. Okay, cool. I was going to ask you for advice. Obviously, one point you've made a couple of times is don't catch the falling knives. And then in terms of opportunistic, one has to be careful as well. But any other advice for allocators or investors?
Yeah, I'm hesitant to provide advice. I think where I would go again is I'm firmly convinced that there's a significant kind of return premium to getting governance right. I think there have been some studies by the Thinking Ahead Institute at Willis Towers Watson, some academic studies as well. And I would say getting the governance, that's 50 to 150 basis points of additional return over time. If you can have best practices, durable governance, I really feel that's a much better investment, followed by the team, followed by all the clever specific asset level things that most of the industry focuses on and chases. So I really, if people need to get input on where would they spend their time at the CIO level, the board level, senior management, I'd argue start with governance. And it's sometimes a slog to work on that stuff. There's a lot of brain damage, but it really does pay significantly, materially over time.
Okay. And anything we didn't discuss that we should have, or that I haven't asked you, or you're discussing with other fellow allocators or managers, or that's just super topical? I guess perhaps outside of the administration and the ensuing turmoil or chaos from that.
Yeah, and I think the big issue a lot of us are facing in the private market space is the continued growth in fundraising in the high net worth, the retail channels. I have a firmly held view that's going to continue. And when I think about the business model of the largest private market asset managers, they can pay fees to the distribution channels to build that asset base, which they have been doing, which is probably pretty close to the fee discounts that they give to large institutional investors. And the retail channel, the high net worth channel, is not going to quibble about side letters and be noisy at LPACs. And I feel that those large managers are going to continue to grow significantly. And we need to just recognize that they're going to evolve towards that side of the business and away from the traditional institutional relationships upon which they built those firms. And so I think for the larger investors, we need to think about how we access, say, private equity, real estate differently. And I think there'll be this continued concentration of asset size, product proliferation, and then there's going to be a lot of carnage in the smaller private equity managers, private credit, real estate, what have you. And that's going to play out over many years. So these firms have captive asset bases, right? Because most of them are in lockup vehicles, or they manage lockup vehicles. So I think we need to think strategically, large institutional investors need to think strategically about how do we best get value for our clients, our beneficiaries. And it's different than what we did in the past.
Yeah, no, totally. I think I have a lot of thoughts. We could do multiple podcasts on the quote democratization of alts. And I do entirely agree that has a material impact on everything. That look at the secondary market has exploded, and secondary retail high net worth secondary buyers are not nearly as discerning, knowledgeable, sophisticated, or able to analyze or understand the quality of the assets, the ex ante return streams. And so all of a sudden you have this massive pool of buyers with much lower fee demands, hurdles, return demands, analysis demands, and bodes very well for the asset managers. I'm not sure it bodes so well for the legacy institutional investors.
Yeah. And I think it leads us to think more about co-investments and directs and being willing to take that idiosyncratic risk as opposed to the blind pool risk. And I think there's plenty of opportunities with some of these managers that have had difficulty raising funds. They still have some really strong verticals. And if a GP has strong verticals and they're able to produce co-investment flow, then to me, that's a great setup for a large manager, a large institutional investor that can take advantage of that, negotiate SMAs and those types of vehicles. One thing we've broadcast to the market is for co-investment flows, we're comfortable paying commercial rates, right? So traditionally, everybody wants co-investments free. But that's not realistic if we're not going to allocate the funds and we're still looking for co-investment flow. So if we want to be early in the syndication or the pre-syndication and we want to be of size, then we should also be willing to pay for deal flow, pay fees, pay carry. So it's a different business model.
Yeah, completely agree. Kevin, that was great. We'd like to thank you for the interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for one of the more thoughtful allocators is thinking about and how they and we may all benefit from it. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you, Kevin.
Thank you, Michael.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.